In this lesson, we'll take a deeper dive into volatility. In the previous lessons, we covered the components that influence an option's price, along with the concepts of intrinsic value and extrinsic value. Now in this lesson, we're going to take a deeper dive into the concept of volatility because of its importance in options trading. We will cover historical volatility, implied volatility, the behavior of volatility, and the volatility index, the VIX, VIX. Also implied volatility trends and volatility skew. Volatility definition. In the context of options contracts, volatility refers to the degree of price variation experienced by the underlying asset. It signifies the likelihood of an asset's price moving either up or down. Increased volatility broadens the range of potential outcomes for the option's payoff. Securities characterized by stable prices exhibit low volatility, whereas those with frequent and significant price changes demonstrate high. Essentially, the more volatile the underlying asset, the higher the premium of the option will be. How to visualize macro volatility. The CBOE Volatility Index, or VIX, was developed by the Chicago Board of Options Exchange to gauge the expected 30-day volatility of the U.S. stock market. It's derived from real-time quotes of the S&P 500 index, the SPX, call and put options. The VIX is a critical indicator of market fear and volatility and tends to revert to the mean. So implied volatility. It's a forward-looking metric used to estimate the future fluctuations in a security's price based on the price of its options. It's called implied because it's derived from the market price of an option, and it's more of a kind of a guess of what the future is going to be, and it's a statistical guess of what the future is going to be. It's possible to calculate how much an asset is expected to move based on the IV, or implied volatility, plus the price, plus the time period left in the option, and this is known as the expected move. So expected move is a calculation derived from the option's implied volatility. It's an estimate of how much the underlying asset's price might move in either direction over a specific time period, usually by the option's expiration date. The calculation, the expected move, can be approximated by taking the option's IV, implied volatility, the price of the underlying asset, and the time that it has until it will expire. So here are the expected moves. You can see that there's different expiration cycles here, and they have different expected moves. So for example, the 18-day here on top is expected to move within the next 18 days. This particular underlying is expected to move about 7.57 up or down. Or if you go out to 116 days, it looks like the expected move is around 16 up or down. So the further you go out, right, the more the expected move is going to be. So volatility versus expected move. So volatility, the definition is the measure of expected price fluctuation of the underlying asset, but the expected move is the estimate on how much the underlying asset price might move in either direction. And then with the indication, with volatility, the higher IV, the higher the implied volatility, it suggests the greater price movement up or down. And with the expected move, it provides a specific range of potential price movement over a set period. Now, historical versus implied volatility. IV versus HV. IV, implied volatility, is a forward-looking metric, right, that we've talked about here, and it's used to estimate the future fluctuations in a security's price based on the price of its options. You know, it's called implied because it's derived from the market price of an option and it's implied. We don't know really what it is. It's more of an estimate. Historical, also known as real or realized volatility, it's backward looking. And it's how much the price of the asset has varied over a specific period of time in the past. It's a hard number. It's done. It's a past number that's real. So in other words, that's why it's called realized or historical, because we know how much that asset or how much that volatility was in the past. To illustrate the difference between historical volatility and implied volatility, consider the analogy of a weather forecast. Just like a forecast attempts to predict future weather conditions, implied volatility estimates future market fluctuations. However, similar to how weather predictions may not always align with the actual weather events, the forecasted market volatility doesn't always match the real market movements. Despite advancements in technology, weather forecasts can be accurate at times and significantly off at other times, mirroring the nature of implied volatility in its predictions versus actual market behavior. The vast majority of time, implied volatility has been higher than the actual volatility or historical volatility. The market has expected more than what actually happened most of the time. In fact, several research reports state that the implied volatility has been overstated, and it's been overstated by looking at the historical volatility, and it's overstated anywhere between 70 to 84% of the time. This means that options are overpriced on average because they can explode. And why does that happen? Why are options overpriced? Well, it's because they can explode in value when an unpredictable volatility event or price movement occurs in the underlying. So there has to be that price of, we don't know what's going to happen in the future, therefore there could be more volatility in the future. So that needs to be priced in. So for example, when the market crashed in March of 2020, the price of puts exploded much higher than expected. And that low chance of that explosion value needs to be priced into the option. The extra cost for the premium gives credibility to the idea that selling premium is better than buying premium. In fact, this is known as the premium seller's edge, which I'll talk about more later. Now let's cover the behavioral traits and characteristics of volatility. Mean reversion. Volatility moves differently than stock prices. Volatility is a mean reverting asset. It usually trades around a mean, and if it moves from that mean, it tends to revert back to it relatively fast. Now, another part, expansion. Implied volatility often rises, a phenomenon known as implied volatility expansion. It happens ahead of events like earnings reports or major Federal Reserve announcement or some type of binary event due to the uncertainty that they introduce. Also, when we talk about behavior, we have contraction. Following these events, these binary events, implied volatility typically decreases, known as implied volatility contraction, as the uncertainty resolves. And here's what volatility typically does. It increases going into an earnings event of a company, and so do the option prices. And you can see what happens after the event. You can see the volatility rising into the event, and then you can see the little green lines there where actually the volatility drops after the event because the event's no longer unpredictable. Volatility skew. A stock has a general level of implied volatility, but every single option in an options chain also has its own implied volatility. So it has its own individual personality, every single option. And the volatility is not always the same for different options, right? The personalities are different. And this is known as volatility skew, right? Or kind of volatility difference. For example, puts generally trade with higher implied volatility versus calls. And this is because the market tends to fall faster than they rise. And option sellers want to be compensated for taking on that risk of dealing with puts. Now, there are two other types of skew to be aware of as well: vertical skew and horizontal skew. Why understanding skew is important. Understanding volatility skew is a key for beginning options traders because you want to know the risk. It shows how the market feels about potential big moves in stock prices. A big skew means traders are expecting something major to happen, like a binary event. Smart buying and selling. So it helps you figure out why some options cost more than others. For instance, why some options for protecting against price drops, like puts, might be pricier than calls, for example. Now, choosing the right strategy. So it's important to understand skew because when you have your strategy, if you understand skew, you can potentially pick strategies that work best for the current market mood or current market environment. In options trading, the term vertical skew and horizontal skew refer to different patterns in the implied volatility of options. So let me explain a little bit. Vertical skew or volatility skew. This occurs when options with the same expiration date but different strike prices have different implied volatilities. Typically, for equity options, out of the money puts have higher implied volatility compared to out of the money calls. The skew pattern reflects the market's greater concern for price declines than for price increases. So for example, here you can see if we found a comparative one, let's say the puts over here and the puts that are out of the money, let's say at around a delta of 40. So here's one around a delta of 40. You can see the implied volatility on the puts is 12.29. And then if you look at the 40 right here, the 40 delta call that's out of the money, it's around 11.2 volatility. So the price is relatively lower compared to the same 40 delta put. So you can see the implied volatility is higher, and so is the price of the option, but they should be almost identical because they're both, at that 40 delta range. That's what makes them more equal, and you can compare them. Horizontal skew or time skew. This refers to the difference in implied volatility across options with the same strike price, but different expiration dates. Generally, longer-term options might have higher IV compared to shorter-term options due to the increased uncertainty and risk associated with a longer time horizon. You can see here, for example, this is 4 days. It's got the IV of 7.6. You get 13 days, 12.6. You can see it just slowly increases the implied volatility as time gets further out, and therefore the price of the options also increase with that implied volatility. In essence, vertical skew looks at IV differences across strikes for a given expiration, while horizontal skew compares IV across different expiration dates for the same strike. There are different ways of measuring volatility, and it's important to not mix them up. Historical volatility. This is how volatile the underlying actually was. It doesn't tell you anything about the future volatility of an underlying. This is also called realized volatility. Implied volatility. This is the market's prediction of how volatile the underlying will be in the future. It could be greater than or less than or about the same as the historical volatility. It's only an estimate and it can easily be wrong. Historical implied volatility. Now this is simply the implied volatility of an option over time. So when you're looking at the historical data and overlay the historical volatility with the historical implied volatility, you can see how right or wrong the market was in estimating the future volatility. Implied volatility rank. This tells you how high or low current IV is relative to historical implied volatility. It's calculated over a period of 52 weeks, and the formula is here in the slide. Implied volatility percentile. Now this tells you the percentage of the time the historical implied volatility has been lower than the current implied volatility. And the formula is here in the slide. In this lesson, we covered historical volatility, implied volatility, the volatility index or the VIX, why implied volatility is often greater than realized or historical volatility, the behavior of volatility, mean reversion, volatility expansion, volatility and volatility contraction, the behavior of also the behavior of implied volatility, the behavior of implied volatility and volatility skew. We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieve my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.